Welcome to the July Economic Impact. Today we have three subjects basically. First, market performance, economic data, and our favorite subject, bank rates. Stéfane, what about the performance?
Every asset class is actually up on the year, led by equities, but it's a marked difference from last year when everything was down. So it's a good start, Denis, and it's being led by equity markets, particularly in the US, where expectations that artificial intelligence, AI, might be deployed quite rapidly and lead to a productivity boom that would support earnings. So really the US is leading the charge this year with a 14% return in Canadian dollars.
Well, as we said at the last economic impact, that 14%, it's really 7 stocks that are really involved in there. It's a lot less than that if you exclude those specific stocks. But still, it's a growth.
Yeah, you're right to say this bull market has bad breath because exactly. It's only a few stocks that are on the way up. Yeah. But Denis, this is pushing valuations to a new high at this. Today, we have the US and the S&P 500 trading at more than 19 times forward earnings, and this is a cyclical high. And this is against a backdrop where interest rates are still rising. You mentioned the Fed policy rate, the Bank of Canada, but the Fed is actually doing the same thing, arguing that more rate hikes are coming. And we're in a situation where for the first time in a very, very long time, Denis, you have to go back to 1999, the rate on cash or T-bills actually exceeds the earnings yield, and this is something we haven't seen since 1999.
Yeah, and when you look at your graphics, you see that when you see those spread really narrowing or getting close to the earning yields, you see recession coming. Yeah, is the data showing that?
Well, the data shows that when you get there, when the cash, you get a bigger return on cash than the earnings yield, that means monetary policy is restrictive, and that means there's normally collateral damage on the economy, which is quite spectacular at this point in time. Is back then, last time we saw it, the market was a little bit more nervous, volatility was higher, but as of last week, volatility is back to a cyclical low. So it's as if people believe that the economy is insensitive to higher interest rates. That's a big assumption at this point.
This is what the U.S. manufacturing activity shows.
Exactly. If you look at the producer side of the equation, you're seeing manufacturing activity falling to a cyclical low. So below 50 suggests manufacturing contraction of activity. This is a level we haven't seen since the end of the pandemic. So clearly, there seems to be an impact on the producer side of things, Denis, when it comes to higher interest rates.
How does it look like for the consumer consumption?
Better, but not much better. Because what we're noticing is that consumption rebounded in the first quarter, more than 4% growth. But right now, Denis, we're looking at below 1%. So clearly, we are noticing deceleration for the second quarter of this year. So this will challenge the assumption that interest rates have no bite on the economy.
Yeah, and we saw over the past years or so that savings were quite high in all countries, and now we're seeing sign of deceleration.
So everyone's been saying that, there's been excess savings built up during the pandemic. Government programs were so generous, they helped consumers. But now what we're noticing is that in the US, as well as in Japan, the excess savings is completely gone. So going forward, you will have to spend on what you were making as disposable income as opposed to your excess savings. So the depletion of excess saving is already there for the US, so it will be more challenging from a consumer spending standpoint.
And then earnings, which is very important for the stock market. How do they look like? They decelerate quite a lot in the past few quarters, and now they're stabilizing, or?
Yeah, we're entering the Q2 reporting season with earnings that are likely to be down a bit, but expectations is that, we've seen that it's a global phenomenon, by the way, this deceleration in earnings, but now the assumption is that profits will rebound as soon as the third quarter. So again, resting on the assumption that previous rate hikes don't have much of an impact on the economy, therefore supporting a rebound in earnings. So again, it's a very challenging assumption, Denis, that will be tested. So that's why we argue that you probably want to be a bit more prudent for the coming months to really assess the damage on the economy.
Yeah, and we know that the Bank of Canada will announce his decision July 12. What about bank rates? How do they look and inflation?
Denis, I have to say, you know, the Bank of Canada surprised everyone in June by hiking rates, and they're likely to hike again this summer. Yes, it is true that interest rates now are above inflation. The good news is inflation is decelerating, Denis. Don't get me wrong. I'm happy about that. What is surprising me and surprising the Bank of Canada is the population surge that we're seeing again this year. It's massive. So it's a lot of increased demand that we're seeing on the economy coming from this surge in population.
Then you're seeing more stabilization of the inflation around the 3% or so for the next few quarters. You don't see that deceleration continue.
It's a good question. I think you can see it on headline inflation, but everything that's related to the housing sector is likely to be more resilient, therefore making the Bank of Canada more prudent. You have to keep in mind that those population numbers are staggering. You know, more than 300,000 individuals in the first quarter of this year. We're looking at, Denis, we had 1 million, more than 1 million last year. It's again another million this year. So the pressure on the housing sector, that's why home prices are starting to increase again, and that's frustrating the Bank of Canada. Yeah. I'll be honest, I did not predict another million increase in Canada's population this year, but this is what Ottawa is dictating at this point in time. So we'll have to live with that decision. That probably means interest rates will be higher for longer and rate cuts will come further down the road than we had previously assumed.
Good. Then no holiday season for the Bank of Canada, July 12th, then you expect another quarter of a point?
I think that there's got to be a rate hike this summer if they're consistent. They have to revise up their forecast, so that's the case, Denis. So this is why we'll be testing the assumption that the economy is immune to higher rates. Might be more immune in Canada, but I think that from a U.S. perspective, it's likely to bite.
Thank you, Stéfane.
Thank you.
Then stay tuned. More to come once again, and thank you for being with us today at the Economic Impact.